Hey, it's CG required cash flow. So if you've been selling your stocks, or if you're thinking about selling your stocks during this time of chaos, during war, you may want to think again. Now I know you've probably been watching the news and they've told you that stocks and war don't necessarily mesh. Well, it couldn't be further from the truth. So you must understand, historically, 1 year after a war begins, usually the stock market is up more than 20%. Now, why does this happen? The stock market is forward thinking. So what it does is it prices in worldly events before they even happen. So leading up to the event, or leading up in this case to war, the stock market is going down because the event itself is surprising. But once we get to the event, the stock market has looked past it. It's actually looking for the next thing that's happening. It is getting back to business. What is business? Earnings, cash flow, which companies are growing. That's business. All this other stuff is just noise. And so what the stock market does is it says, okay, we know that the war is here. Now, how are we going to position ourselves when this war is over to be inside the best companies? And that's why it rallies. This weekend was no different. We had strikes this weekend with Iran. But what's happening today? Today, the market is flat. You would think it would be down 2 to 3%, but no, it's flat. It's because the market has already looked past what's going to happen with Iran. In case you're skeptical about some of the things I just said, let's just look at some hard examples. 1990, the S&P 500 fell 17%. 12 months later from the bottom is up 29%. September 11th, the market fell 12% in the opening week. 12 months later is up 15%. Cuban Missile Crisis, the market fell 7%. 12 months later is up 30%. So now that you see historically what happens after a war, what you don't want to do is sell your stocks and wait to try to jump in at the right time. Because you could try to buy back in once the market is up 5%. All of a sudden, once you get in, then it sells off. And then now you're upset. You sell again at the low and you become what's called a perma-bear. You're a person that hates the market. Don't do that. Instead, look into your opportunity account. I often talk about your opportunity account on this channel. And this is one of the reasons why. Because if you had 20% or 25% of your cash inside your opportunity account, you could be slowly dollar cost averaging as these assets go down in value. And then let's say if the stock market was, let's just say it was to retreat, let's say 10%. Next year, if it goes up 20%, like it has done on average after a war, then the assets that you bought down 10%, they're now up 30%. See how that works? So I don't know what you guys are doing, but myself, I'm buying. Stay quiet. Allow your cash flow to compound. See you guys in the market.